Alright, let's talk about something that's on everyone's mind right now, getting paid without really having to do anything. I mean, who doesn't love the idea of money just showing up in your bank account, like clockwork, every single quarter? It's the dream, right? But here's the thing, a lot of people chase after these super high-yield dividend stocks that promise the world. Poof, the company cuts its dividend, the stock price tanks, and you're left holding the bag. It's a classic mistake. And honestly, it's a painful one to learn. I've seen it happen time and time again. The real secret, the one that the wealthy have known for decades, isn't about chasing the highest possible yield. It's about finding companies that are so stable, so reliable, so fundamentally sound, that they just don't break. These are the companies that have been paying and, more importantly, increasing their dividends for longer than many of us have been alive. They're the bedrock of a solid portfolio, the kind of investments that let you sleep at night, secure, and actually growing over time, no matter what the market is doing. So for just the price of smashing the like button for the YouTube algorithm, today we're going to be breaking down 3 of my absolute favorite Canadian dividend stocks that are, in my opinion, practically unbreakable. We're going to go through exactly why they're so resilient, how they make their money, and why they've been able to consistently raise their payouts for decades. This isn't about getting rich quick, it's about building real, sustainable wealth, one dividend payment at a time, so make sure to stick around because you're not going to want to miss this. Chapter 1. Alright, kicking things off with our first pick, and this one is an absolute titan of stability. We're talking about Fortis, ticker FTS. Now, if you're looking for a stock that embodies slow and steady wins the race, this is it. Fortis is essentially a fortress for your dividend income, and when I say that, I'm not exaggerating in the slightest. This isn't some flashy tech stock that's going to double overnight. It's something much better for an income investor. It's predictable. Think about it this way. What are the last bills you would ever stop paying, even if things got really tough financially? For most people, it's their utility bills. You need to keep the lights on, you need heating in the winter, and you need electricity to charge your phone so you can watch videos like this one. Fortis is one of North America's largest electric and gas utility companies. They own and operate utility infrastructure in Canada, the United States, the Caribbean. This is their core business, and it's an incredibly resilient one. The real magic behind Fortis and why it's such a dividend powerhouse is its business model. The vast majority of its assets, almost the entire business, are rate regulated. What that means is a government or regulatory body basically pre-approves the rates Fortis can charge. This removes a massive amount of volatility and competition from the equation. They have a virtual monopoly in the areas they serve, and they have a very clear line of sight into how much money they're going to make. This predictability is a dividend investor's best friend. Because Fortis knows, with a high degree of certainty, what its cash flows will look like year after year, it can plan its finances with incredible precision. This allows them to do 2 things exceptionally well: reinvest in their business to grow it, and return a steady, growing stream of cash to shareholders in the form of dividends. There are no big surprises here, just consistent, reliable performance. Fortis has increased its dividend for 51 consecutive years. Let that sink in. They raised their payout through recessions, the dot-com bubble, the 2008 financial crisis, and the global pandemic. The company has a clear plan for the future. They've laid out a massive $26 billion capital expenditure plan through 2029. This isn't spending for the sake of it. It's strategic investment into upgrading the grid, expanding their renewable energy portfolio, and making infrastructure even more reliable. It's all about growing their rate base, the value of assets they can earn a return on. By investing, they systematically grow the foundation of their earnings power for the next decade. And because their business is regulated, as they invest and expand their asset base, regulators allow them to earn more money. It's a straightforward, powerful cycle of growth that fuels dividends. Fortis is targeting annual dividend growth of between 4 and 6% through at least 2029. They're essentially telling investors, stick with us, and we plan to give you a 4-6% raise every year. This guidance is supported by that $26 billion capital plan. You're not hoping for growth, you're seeing the blueprint for it. For anyone serious about a dividend portfolio that lasts, Fortis is a must-consider. It's the very definition of a sleep-well-at-night stock. You're not checking the price every day, you're simply collecting growing dividends and letting compounding do the heavy lifting. It's boring in the best possible way. Boring is beautiful. This is why it's number 1 on the list. The combination of a regulated monopoly, incredible dividend history, and a clear funded growth path makes Fortis a true fortress. It's built for the long term, and for investors who share that perspective, it represents one of the most reliable ways to generate growing passive income. Chapter 2. Okay, moving on to our second unbreakable Canadian dividend stock, Dividend, Obdredius, Non-Bambarburnatistalman, Ninderberti, an absolute giant in the energy infrastructure space. We're talking about Enbridge, ticker ENB. Now before anyone clicks away because they heard the word energy, it's critical to understand how Enbridge actually makes its money. This isn't a company that's drilling for oil and subject to wild commodity swings. It's much more stable than that. Think of Enbridge as the toll road operator for the North American energy sector. They own and operate a massive network of pipelines. They transport crude oil. They transport natural gas. They transport natural gas liquids. Enbridge moves about 30% of all the crude oil produced in North America, and nearly 20% of the natural gas consumed in the United States. They are, quite literally, critical economic plumbing that keeps the continent running. The key to their stability lies in their business model. Enbridge doesn't make money based on the price of oil or gas. Instead, they operate like a delivery service, charging fees for volume that moves through their systems. It doesn't matter if oil is $50 or $100, they get paid to move it from A to B. That insulates them from gut-wrenching commodity volatility. Even more secure, the overwhelming majority of their business is backed by long-term contracts. Much of it is regulated. We're talking about 80% of their EBITDA being supported by these arrangements. Many are take-or-pay contracts. Customers pay for capacity, whether they use it or not. Result, durable, predictable cash flow. While oil producers ride a roller coaster of booms and busts, Enbridge is consistently collecting its tolls. That durability is why their dividend track record is so impressive. They've been paying dividends for over 70 years. And they've delivered 30 consecutive years of dividend increases. Right now, Enbridge offers an attractive dividend yield, typically around 5.5%. It's a higher starting yield than many utilities, making it compelling for income-focused investors. But it's not just a high yield, it's backed by a high-quality, durable business. Can they sustain it and keep growing it? The answer is in their growth strategy. Enbridge is not standing still, they're modernizing and expanding their network. Projects to increase pipeline capacity, building new infrastructure to connect new sources of supply and demand, and importantly, investing in lower carbon energy. That includes natural gas infrastructure, and renewable projects like offshore wind. This balanced approach creates multiple avenues for future growth. Every completed project adds another contracted or regulated cash flow stream. That new cash flow funds future dividend increases. Scale is a massive competitive advantage. Replicating their network would be virtually impossible. The cost would be astronomical and regulatory hurdles are immense. This creates a massive moat around their business. Combine scale, contractual protection, dividend history, and strategic investment. You get a powerful investment case. Enbridge offers high current income with potential for moderate, long-term growth, a cornerstone holding for a Canadian dividend portfolio. So while the headline yield might scare some, when you dig into how they make money, it's anything but risky. The durability of their cash flows supports the durability of their dividend. Alright, for our third and final unbreakable dividend stock, we're moving from the pipelines that move energy to the railways that move, everything else. We're talking about Canadian National Railway, or CN, ticker CNI in the US, and ticker CNR in Canada. If Enbridge is the plumbing of the economy, think of CN Rail as its backbone. It is an essential part of the North American logistics and supply chain. CN operates a vast rail network that spans Canada from coast to coast and extends deep into the United States, down to the Gulf of Mexico. This is the only transcontinental railway in North America. They transport a highly diversified mix of goods, consumer products, grain, lumber, coal, cars, chemicals. Many of the products in your home were likely moved by a CN train. The railroad business is powerful for a few key reasons. First, demand is remarkably steady over the long term. While there can be short-term fluctuations, the long-term trend is consistently upward. Second, the industry is a classic oligopoly. In Canada, there are only two major players, CN Canadian Pacific. Barriers to entry are effectively infinite. No one will build a new 20,000-mile transcontinental railroad. That gives immense pricing power and protects long-term profitability. CN's strong position and essential service lead to great financial performance. CN is known for incredible operational efficiency. They focus on the operating ratio. Lower is better, and CN is one of the most efficient operators. Efficiency means more revenue becomes profit. Those profits and steady cash flow fund shareholder rewards. CN has increased its dividend for 29 consecutive years, since 1995. Every year investors received a raise. CN's dividend yield is often sub 2%, lower than Fortis or Enbridge. That might seem unexciting for income investors, but CN is a dividend growth monster. The starting yield is low, but dividend growth is phenomenal. Over the last decade, CN's dividend grew at a double-digit compound annual rate. That's where compounding shines. A low yield growing 15% a year can surpass a high yield growing 2% over time. Investing in CN is a long-term play on a growing income stream. The ability to fund dividend growth comes from growing EPS. Management targets double-digit EPS growth. They achieve it via volume growth, price increases, operational efficiency improvements, and share buybacks. Management expects a rebound in double-digit EPS upside in 2025. That's based on improving economic conditions, continued strong demand, and efficiency gains. That outlook supports continued rapid dividend growth. Buying CN is buying irreplaceable infrastructure, BAO, the backbone of North America. You get a wide competitive moat and pricing power. You get operational efficiency and a management team with a long track record of returning capital. The story is total return potential, not just starting yield. Combine a safe, growing dividend with capital appreciation potential. For long-term investors, CN is a compelling dividend compounder. Hold for decades and watch yield on cost grow. CN offers a different value than higher yield utilities like Fortis or Enbridge. It complements them in a diversified dividend portfolio. High, stable, income from Enbridge, moderate yield, and growth from Fortis low yield, but high growth from CN Rail. Together they form a powerful, unbreakable foundation for passive income. CN Rail is a long-term wealth-building machine, so there you have it. 3 absolute pillars of the Canadian market that you can build an unbreakable dividend portfolio around. Fortis, the stable utility; Enbridge, the high-yield pipeline; CN Rail, the dividend growth machine. Each one offers a slightly different flavor of income investing, but they all share the same core ingredients. They're critical businesses, with huge competitive advantages, and a long proven history of rewarding shareholders. This doesn't make flashy headlines, but it makes for a stress-free, profitable investment journey. Remember, building wealth through dividends isn't a get-rich-quick scheme, it's a marathon, not a sprint. Focus on quality, consistency, and a track record that proves commitment through thick and thin. These 3 companies epitomize that philosophy. You're not just buying a stock, you're buying a predictable, reliable, and growing stream of cash flow that can help you achieve your goals. Retiring early, funding your lifestyle, or having extra security. As always, not financial advice. Do your own research. Hopefully this breakdown gives you a starting point to build your bedrock. It's about playing the long game, decades of success. Thanks for watching. Smash the like button, subscribe if you haven't, and I'll see you in the next video.